Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, July 7th, 2020. What I'll do in this video is an update on the broad markets, but when we look at the charts and not spend too much time there, I put up intraday and daily charts yesterday. Kind of just look at the big picture of what's going on and talk a little bit about the fundamentals. A lot of what I do on the site is technical analysis. That's charting stocks, the stock market, commodities, things like that, looking at the charts, whereas we can look at fundamentals. Now, we'll use charts as well to look at the fundamentals here, but that tells what's going on right now, and the unusual are probably the biggest disconnect in history between the fundamentals of the economy and the stock market. So we'll start out here with just what's going on recently. I'm in quasi-vacation mode because I'm here. I haven't gone anywhere this year. Usually around the 4th of July, before or after, around that period. Typically that's where I'll take the family on vacation. And like most folks, we're not traveling this year, so working from home. But it's a time that I try to stay away from the market. One of the reasons there is the low volume. During we had the 4th of July weekend. Markets were closed on Friday, of course, for that here in the U.S. And what you see is a lot of folks are in vacation mode, whether or not they're even traveling. You can see here volume has just been really dropping off lately. This is a 10-day exponential moving average on the volume. The volume bars are below in gray, and that's typical. And it's also something to watch for. After you get a period of volume, I have a red line here that in the past on certain indexes has really triggered a lot of corrections when you get to that after an advance. Of course, you want to look at after the market's been rising on declining volume, because every now and then people ask, hey Randy, you don't talk about volume much, do you use it? I do, but usually on the extremes, day to day. Sometimes you get these random volume spikes. You're also going to see higher volume on sell-offs. You have to take that into consideration. But when you have an advance and the market's rising and the volume tapers off, it's usually when it reaches a certain threshold. It just shows that the markets are lifting up. They continue to rise, but once volume starts to taper off, my interpretation of it is that shorts sort of give up at that point, and then the longs kind of dry up. They use up all their dry powder, and then you get your corrections. You hit that level, and then you get your corrections. You hit that level. Sometimes it'll stay low for a while, and persistently rise on persistently low volume is often a pretty bad sign when you get that. And here you can see again we hit it to the left of the chart. Big drop back there in late 2018, and so we're heading that way. And again, if the takeaway is look, I view these kind of rallies like a game of musical chairs. As long as the music's playing, that's fine. But it's just like not my comfort level. I'm not trading actively in the market. Low volume markets, really, you don't want to. You want to stay away from, ideally, my opinion. At least I do at this point in time. But I wanted to go over some things that I'm seeing here. And first of all, I wanted to talk about, I'll call it the tale of two tapes. There's two markets. I tried to get to some of the questions earlier this morning from yesterday, and someone made a comment about a runaway market. Let's look at QQQ. There's a runaway market if you look at QQQ right now, and that's it. And you're also seeing volume dropping off. You can see the volume trailing off here in the Qs as well. But remember, of all the major indexes and the things I cover, this one is not. It's diversified in the sense you have 100 stocks, but it's not diversified as far as the economy. Here's the breakdown in QQQ. Nearly half of the Qs is tech. Right here, it's your information tech. These are your tech stocks. About 50%, 47 right there. And of that, of course, you can see that it's just in that tech sector, the top two alone make up about 23% of the entire of QQQ, not just the information type. I believe that's the total weighting within QQQ right there, if I'm not mistaken. And so that's the tech stocks. Then you have communication is the second largest weighting sector in there, and you have of that, there's Alphabet. Both share classes together make up about 7%, and then Facebook rounding out at 4. So you can see, and then you go down the line. Third largest is consumer discretionary, but it's all about, again, one stock here. One stock is going to move the needle on it. The rest won't. Even Tesla, as big as Tesla, or as much as people love the stock and getting into it, it's not going to move the needle on QQQ hardly at all. And again, it's that whole FANG thing, and this is it. So you have really, as I said, you break it down, and you only have a handful of sectors. Even have a small representation of healthcare. What you're seeing here, you're lacking financials. So this is not a proxy for the stock market or for the U.S. economy. Even those communication companies are, you can call them tech. There's Alphabet, Facebook, Netflix. So it's pretty much a tech fund. I talk about that all the time, but I think it bears repeating. New people are coming into the site. So, when I say that, there's it's a tale of two tapes. You have QQQ, and then you have the stock market. This is the S&P 500. This is made up of 11 sectors, and even subsectors within, but 11 primary sectors, including financials, much more diversified. It does have a high weighting on those, overweighting on those top stocks, because it's also a market cap weighted index. But here's the thing. As far as the market goes, let's toggle over to a daily time frame here. We haven't gone anywhere now. If I grab today's candle right here, let me try to not do that. Okay, I'll try to grab close enough. I'm going to have to grab the bottom of it, or I have to turn off my annotations here. We are right now where we were approximately 1.1 months ago, about 5 weeks ago. We had a little pop up here. We put in that island cluster top, and we've traded sideways since. So somebody asked today, is that sell signal, is it negated? Look, my answer to that question was no, but ideally, number one, when we had the island cluster top right there, you had two things that happened on July 11th, or June 11th, I'm sorry. You had the gap down below the trend line. That's our primary bull market trend line right there. Gap down. It also put in that island cluster top. As I said, you don't want to see the top of the island taken out. Ideally, now we didn't get ideal. Ideal number one would have been additional follow through to that red candle, another red candle the second day right here. We didn't get that. Other than that, and that's not an absolute must, but sooner than later we should have gone down and took out the bottom of that candle. We did right there, and then no more. So we've been locked in a sideways trading range. Does this have anything to do with the amount of liquidity the Fed's injecting into the market? Undoubtedly, unarguably. I don't think anybody can sit here and say this hasn't had an impact. Is the sell signal still intact? Well, yes. We haven't taken out the top of the island. If we take out that island, then it is. The sell signal is taken out. So basically what we have is a market going sideways, and that is, all I can say is that's not ideal or conducive to the case for a bigger drop. And as I said, even at the time and since, if you can't see them now, I have them turned down, but you have a cluster of key moving averages, the 200-day simple and exponential, the 50-day, they're all right here. They all come in together just below. So that's what's happened. We got the sell signal, but a lot of individual investors, professionals, the algos, computerized trading programs, they've stepped in and bought at that level. Those are key support levels. They were resistance over here on the way up, and now they're support, and they have been for years. Those are the big moving averages a lot of people look at. You probably throw the 100-day, it's going to be in there, obviously, because there's your 50-day and your 200 days, and they're all in there tight together. So that's it. So let's not try to make anything more of it than what it is. But one thing it's not, the market's not going down, but it's not going up, at least not now for the past 5 or so weeks here. At this point, it's been going sideways. So that is, again, the stock market. As far as where we are in the bigger picture of things, the stock market, the S&P 500 is still about 7%, a little better than 7% off its all-time highs. And then even the small caps. Small caps are, you tend to have more domestic companies here, or I'm sorry, a lot of domestic companies here, I should say. 2,000 stocks in the Russell 2000 index, small cap. So this is also, pretty representative of the economy here. And you can see it's still, well, we got it all the way back to 2018. That's when the Russell topped, and the mid caps and everything else. So they've been in a bear market since then, and still by every metric it's still down almost 20% off its all-time highs put back in 2018. So again, it's sort of a dichotomy, if you will, when you look at the various indexes. This rally has been fueled largely by tech. In the last, especially in the last couple months here, a lot of things exploded off the bottom. Just about everything that was kind of a reinflation trade. All right, in the big levels, as I say, 145. Somebody asked me, because it's on my chart, it's listed as 145.08. That's not a hard line. If you zoom in real tight, you can see, and I'm going to put the crosshairs here. If you look at the pop-up box to the left, the crosshairs are on today's candle, and it shows you that the 200-day simple moving average is just above at 146.34. Here, I can turn that up for you. And so there's a story on the small cap. So just like the S&P 500 is at resistance, it's at that testing the top of the gap from that sell signal back on June 11th. You have that key 200-day moving average. Remember, we were in a choppy sideways trend here, so you're going through it, but overall it does a good job. When you come back here, you can see that that level in a bull trend will act as support. Again, that's this blue line. If you can't make it out on the chart, I'm drawing it here. Support in a bull trend, and you break down, then you're in a bearish trend, and it often acts as resistance there. And so that's resistance overhead. So just wanted to point out that not only do you have 145.08, that comes in a little north of 146. So that's more of a resistance zone, about 145 to 146-ish. And as of now, we're still below it. We pretty much closed right on it yesterday. You can see that yesterday's candle, and we're rejected as of today. But like the stock market, let's not read too much into it, because we're not going up and we're not going down like the broad market, like the S&P 500. We're going sideways here. That's it. So if pretty much a solid break above 146, let's say 146-ish, will have taken out that 200-day, will have taken out that 145-ish resistance right there, and would be bullish. There's still a previous reaction high, and it's still going to, IWM will still be well below its previous highs, but I won't be able to chalk that up as to anything but a bullish near-term event. Now, is it a breakout you want to take? Well, that's up to you. It'll depend at the time what the other indexes are doing. In other words, is SPY still struggling with the resistance I just showed you it was at today? What's QQQ doing? What do the 60-minute charts look like? What do the futures look like? Here's NQ. This is what I showed you yesterday. I believe this chart here. We broke down below that wedge, and we're back testing it. And same story. We just inch up, make a marginal new high, divergent high is what we've done today. And usually get at least these corrections off the divergent highs, why we've been stair-stepping higher. So that's what it looks like. Is that a sell signal? Technically on the breakdown it was, but we're back testing now. And again, there's just been a relentless bid beneath the futures. So like I said, you can trade if you want. These are the levels to watch. This is resistance on the S, I can tell you that right now. And is it objective to short here? Yes. Is it objective to go long here? No. It would be if we pop much higher, because you've taken out resistance. That's the same gap. There's that island back from and the gap down. You don't see a gap down on the futures because they trade around the clock. They started sliding before we opened up on June 11th, so the S&P 500 gapped down that day, but that's that same island cluster right here to the left of the chart on this 60-minute chart of the futures, and we're back testing that resistance level from below. That's 31.75, and so while it would be objective to take a breakout, it's not the type of breakout I like. Why? Because breakouts that occur with divergence have a much higher rate of failing, meaning they break out, buyers come in, you see a little surge in volume, and then you reverse. And that would be, even if it's not a super high probability, it is a probability. The odds are favorable, meaning better than 50% that you get a false breakout and then a quick move down. And when that happens, it's usually pretty powerful if you get a failed breakout. So again, low volume too leads to whipsaw signals. So you can almost expect that. I wouldn't bank on it, but to get a pop like that, if it's going to happen, it's easier for the market makers to do, for the powers that be to happen on when volumes are real low, trading volumes. And here it is. I just put the volume up for ES. Again, these are the 60-minute chart of ES. And you can see it. And I pointed out the volume has been, in fact, the last time I showed you that was right here. And we continue to taper off to really pretty, levels that pretty much trigger some bigger drops on the daily chart that I started with. I'm trying to move that line here. It's not cooperating. I'll put a second line there, and you can see it. So you get these volume drops. What I was showing you recently, I think last week, volume starts to taper off like this, and boom, you get a correction. You start to rise, rally, volume starts to taper off, boom, correction. Volume's been tapering off. It's been a little bit longer leg up. You've got the divergence in place, everything else, and again, low trading volumes brings a rally into question. That should always question a rally that is moving up on lower and lower volume. Just like I like to use volume for breakouts. I like to see breakouts. If I'm taking a long side bullish breakout, I like to see it occur on 1.5 times or better the average volume. I'll look at the 60, 90, 100-day average volume on a stock, and those that occur on high volume above average have a much higher rate of sticking in playing out for a true breakout. In fact, I'm going to show you some stocks that have recently broken out. We're going to get to some trade ideas here in a second. But let's just talk fundamentals real quick, and why I think that the upside's limited right now. Talk about the disconnect. I'm sure you've heard it on TV or read about it elsewhere. Here's one of many sites I like to use to look at some of the economic indicators. So we're looking at charts, but that's on fundamental analysis. It's really looking at the fundamentals of the U.S. economy, like you'd look at the fundamentals of a company. Forget about that one. Let's look at continued jobless claim. We'll just click on a few of these. And the charts are all the same. This is, we're going back here to the 70s, 80s, 90s. These shaded gray areas here are recessions. You don't see that here, because a recession is defined as 2 contracting quarters of GDP, and recessions are always identified in hindsight well after they start. So at some point you will see this populated here as that we've already started a recession. And again, you've seen nothing like this. The unemployment rates spike up, and yet there's that disconnect between what the stock market is doing and what's going on in the economy. Make no mistake about it. It's no different from a company that is soaring despite horrible fundamentals, not being profitable. Think back to the days of the dot-com bubble, things like that. And there's been other companies out there. Their valuations get way ahead of themselves, and then the reversion to the mean is pretty ugly. So let's just look at a few more, and we'll move on here and get to some individual stocks. So that was jobless claims. There's the 4-week average of it. Here's a big one. Light auto and light truck sales. You can see, during recessions that drops off. They typically, get to a high end of the range. The high end is about here. I'm not going to draw it's kind of changed over time. There's been a few aberrations, these little spikes above, but you can see that's about the ceiling during a economic expansion. You stay up there, economy's good, everyone's buying cars and trucks and all that, and then you have this recession was a brief one back in 2000. Again, the market plunged, especially the NASDAQ, because it was a bubble in the dot-com stocks, and there's that great recession. So auto sales kind of hung in there for the most part and then fell off a cliff. And here it is again. And all this stuff matters. It will matter over time. And yes, there's been a rebound, but look where we are. If you smooth this out, put a moving average, this line is still going down. Obviously, with the shutdown we had in the economy, a lot of states locked down, sales fell to an extreme. But here's where they're at now. You can see, I think you can see them right where the crosshairs are. So that's another one to look at. And they're all the same. You can go through it. You can go unemployment rate by education. We'll look at that one real quick, because that speaks to, what's going on in the stock market. These people, college graduates, tend to, but I don't want to, completely stereotype or niche in, but they tend to be, more of those investing in the stock market, but not necessarily than those with less than a high school diploma. I think that's safe to say. However, this is a larger subset of the population, or these are down here, and and consumer spending at the end of the day accounts for about 2/3 of GDP, up to 70% by some measures. So with unemployment spiking across the board, that that's not a good thing. Here's probably a better one to look at, the U6 unemployment rate. You can get the definitions on here. U3 is the official unemployment rate in the U.S. U5 includes discouraged workers and all other marginally attached workers. U6 adds on those workers who are part-time purely for economic reasons. So a lot of folks will go by the U6, and look at, I mean, just look at that spike up there. And yeah, has there been a blip down? Absolutely, because we had the shutdowns, a lot of people getting back to work with the partial reopenings. But again, if you smooth this out, this is still a big spike, and it's no different than all these other past recessions, and they were all associated with bear markets. And not a bear market that lasted a month or two. Some other ones I like to look at are industrial production. This is going back for years here, and let's see if we can tighten it up a little bit to the last couple of recessions. Industrial production has fallen off a cliff, and the scary thing is this is just the initial drop. If you look at it in time, it's like about comparable to probably right here. So let's just say we get another blip, like you had blips along the way here. To think this is a one and done and we're going to see this, hey, anything's possible, but it's very unusual. So by most metrics, at least right now, and we can sit here and argue all day long if the stock market and the economy is going to do this or this, but all we know is this is where we're at right now, and at no point in history have we seen a drop anywhere remotely close to this, even take half of it, and not been in a bear market that lasted a year, 18 months or more. That's the average of, I think, is about 18 months on a bear market. And that's it. I won't beat a dead horse here. Some of the ones you look at, retail sales fell off a cliff. Yes, they rebounded. Obviously, you're going to see a sharp rebound here because everyone's in lockdown mode there, and you weren't going out to stores buying things, and we've seen more of that coming back. But even if, again, take where we're at on the most recent reading right here, that by all accounts is that's how recessions start. And again, this one was a little blip on the radar. It was technically a recession, but a short one. This was our last recession, and you can, again, go back as long as you want. I guess that's as far as this chart goes. And the last one I like to look at, too, durable goods. Again, falling off a cliff. All these numbers, all economic indicators are pointing to the start of what's probably the worst recession in history. It'd probably be much worse, I think, before all said and done than what happened that 2007 to 2009 recession. But we'll see. So where to make money? Well, not here. Again, there's the small caps, like I showed you, going sideways for months. Again, more indicative of the economy, the stock market, and not just five top-weighted FANG stocks. The S&P 500, even though it has a higher weighting on the FANGs, they're in there, and they have, because it's market cap weighted, it's still showing you the stock market is not going up. QQQ is going up, and that's not the economy, and it's not the stock market. It's a frenzy to buy big tech stocks right now. All right, so that's it. Let's move away from that and look at where the opportunities are. I have a couple. I had a list. I had one that I wanted to point out. I put this one down the other day. The rest are going to be in a different sector. I just spotted this one a couple days ago. GEVO, big divergent low right here. It's a chemical stock. Penny stocks, you got to be careful with it. Again, if I was at my desk more yesterday, I would have covered this one. It's up again today, but not too much. It's given up some of the gains. It went in, backfilled that gap, got checked by that gap. So it's one to watch. PPO is starting to turn up. If it continues up, that'll confirm the divergence. Your targets here are this trend line, 150, 184. Where to buy it now? Well, it got checked on that gap. I prefer to see a pullback. They just had a stock issuance the other day. That's what put it on my radar on this big green candle. I think it was 10 million issuing shares for purposes to they must have some plans obviously for that money if they're going to issue stock. Now, again, excuse me, you have to be careful with these low price stocks here, penny stocks. But it's one that I do think has upside potential, and I'll try to follow up with it and let you know if I see an objective entry. One level I'm looking at, if we backfill yesterday's gap right there, take a shot in there around the 70 level. We're at 71 right now, down to about 67 with a stop not too far below. This could prove to be a one-day wonder. Don't want to talk on it too much, again, because of the speculative nature of a penny stock, especially one that's just had that stock issuance. But again, the market obviously liked it the other day. It had a big lift, and again, it's the chart. The chart to me is pretty bullish, saying that we could get a run up here, and if we do, that's a double on your money. So it's, the thing is with these low price stocks, penny stocks, you take a very small amount, a small fraction of what you'd put in QQQ or SPY, call it your Vegas money if you want, put it in there and use a wide stop. That's the only way to trade these, so you're going to get stopped out in the day-to-day gyrations. You could use a 10, 15, 17, 18, 20% stop on there because you're targeting 100% upside or more if that one plays out. But let's move on to the sector that was moving yesterday. Some news out of China trying to pump their stock market, and so what caught my eye are a lot of the internet content. This is a subsector in the technology sector. The subsector is internet content and information. So a lot, not all, but most of these I'm going to show you right now are Chinese companies, and some of them, these are some of the ones that caught my eye yesterday. I'm going to try to put a trend line there. I don't want to force it. Let's see. I think that's probably the better fit right there, and I'm going to move it up here to that point. Yeah. All right, so I'm going to rifle through these because I don't want the video to be too long, and I'll do an update if I see some follow through. Today, some of them are following through, not all of them. In fact, let me show you what we're going to go over here. As you can see, these are the ones I have flagged that stand out, and it's nice because quite a few of them are pulling back today. Some are following through. When I say here, I'm showing you with the ones I have flagged with this little blue flag. So all the way down. TrueCar is not really one of them. A couple I had a question mark by, but here from Mark down to TRUE. All right, so let's go through these in order right here like this. Okay, Remark Media. This one looks like a potential flag, although a little bit of a whipsaw. So I watched this one. I would sit tight and see if it can get back above yesterday's high, because what we had here, what looks like it was a very impulsive move up. This level of consolidation, which takes the form of a bearish bear flag or bearish pennant there. We had what appeared to be a breakout yesterday because we had a lot of movement in the sector, and that's why I'm doing the video today, because so far it's not a runaway thing. We had quite a few breakout and some that have already broken out. If this one can hold up here, I think that would do the trick, a pop over yesterday's high. It's a pretty low price stock. It's around $2 a share, and the measured target, I have my concerns how much more upside's in the market right now, and these guys are going to probably be impacted by what the broad market does. That's what would roughly be your measured target for that pattern right there if it plays out. It also got checked here at resistance as well, so that's another level. You have a big gap right there, price resistance here, all around 314 level reaction high. So although a pop above yesterday's high could do it, and most might take a partial position, a half or a third starter position, and then wait till 314 goes with conviction as well. All right, I'll go through the rest of these a little faster. QTT, watch, rinse, repeat with these divergent lows right here. You got divergent low at this point, rally. You broke that uptrend line, correction. You put in a divergent low here, it was rallying, and it had this level here at about 309 right there. Almost a rounding bottom here, and then it recently broke out. So this broke out before yesterday. This one broke out was at on Thursday, and followed through yesterday. Taking a little bit of a breather today. Look, these are volatile little stocks. It's a $3.84 stock. It's down 8% today, but healthy so far. It's still above yesterday's candle. And target on this one, I don't really see much stop in this one. If the sector can continue with this momentum, it may be a one-day wonder, and that's why I'm doing the video, so you can keep an eye on these and see if we get another leg up. I'm going to add another target right there, about 488, and then potentially 641. Momo. Nice big breakout yesterday. Big green candle right through the downtrend line right there. Falling wedge pattern. Divergent low under the wedge. Positive divergences. Breakout. And it's taking a little breather today. Pull back to back test. There's a gap right there as well. Maybe if it comes in, test the top of that gap. I'm talking on the breakout candle right there. About $19. With a stop not too far below. Maybe not much lower than the bottom of the gap right there. About 1850 or so. YY. That one stands out. It's been stair-stepping higher, and it recently took out that $88 resistance right here. You can see it's a pretty nice resistance defined by these reactions here, gap right there, reaction high right there. Took it out, broke out, back tested, and it's holding above. So its objective right about here. It's at 87.40 right now with a relatively tight stop because if it goes much lower, it means the breakout failed. And again, you want to keep an eye on the sector. Birds of a feather tend to flock together, and so you want to keep an eye and make sure you have some follow through to yesterday's bullish moves on a lot of these stocks, especially those that broke out. If you start seeing a lot of breakouts fail, pulling back down below, rising wedges and horizontal price resistance levels that were well defined, then that's not a good thing. All right, next up, PCOM. There's a downtrend line coming off a divergent low. It's had a nice run. These stocks move pretty sharply when they do run. I highlighted this sector last year, I think it was, at one point. We had a lot of nice trades on these, and I did it like this. I did unofficial trade ideas because there's so many. What I like to do is take a shotgun approach. Now I'm holding off for the reasons I told you before. I'm not going to be in front of the computer as much this week. And a little bit suspect of the breakouts yesterday, or at least watching them for now. And this one needs to take out this trend line right here. If it does, 1068 looks like a pretty good level, and possibly more. It all depends on what kind of momentum the sector has. PPO is up in bullish territory above the zero line, this dashed line here, and it looks like it's starting to curl back up. So if this one can pop, just to run back up to that 1070-ish level there, right there is about 14, almost 15%. And maybe it has more after that if it can take that out, but I think we'd get a reaction if it gets to that level again. Baidu, B-I-D-U, this one nice breakout. It was testing this trend line, broke out yesterday. Like I said, that's where I'm highlighting this sector. Quite a few. It was dancing around the trend line, gapped up, breakout, has resistance here, 134.41. Next target after that would be about 156.15. Possibly all the way up here to 176.36 if, again, this sector can follow through on those breakouts in this stock and of course as well. Even to that 156 target, let's just say you want to get in there, that's about a 21% return. Big old gap right there defines that level. And again, coming off a big divergent low right here, bullish divergence. IQ, what I see on this one is just a stock. This one looks like it came public back here in March or April of 2018, late March maybe, and has been working between this level. It certainly has support here around 15.25. Sometimes you get these little whipsaw moves through, but a lot of reactions there. So we're not there now. If we were there, I'd say that's an objective long entry. We're closer to the top of the trading range. So at this point, I'm on lookout for a possible breakout. You have a maybe downtrend line here. Maybe because there's only a couple reactions. We haven't even hit it for a third time. And iffy resistance about 28.55 because there's not a lot of, you only have this reaction here, a couple there. So really what I see is this kind of boxed in range. It's traded most of the time. Since the initial surge, it went public. Sometimes people get all crazy with these IPOs, and that craziness fades. It takes a while for the street to really kind of value that stock. Hey, where should it be priced at? And sometimes it takes a few years after an IPO, and that's what's going on here. So pretty much pop above that level would I think open the door for a move up here to probably about 38, 33 or so. SINA, another one that broke out. This one actually broke out day before yesterday, or the trading session that was on Thursday, and before, remember, markets were closed on Friday, there was a breakout candle, nice and green, big green candle above the downtrend line, had been consolidating there, parked right about on the 200-day exponential move or simple moving average, and then boom, gapped up yesterday, nice follow through, and kind of taking a breather today. So here's another one that's broken out. Sort of hanging in no man's land. That's what I call when a stock is between support, which would be the trend line, or really that recent price consolidation. I could put a horizontal line there and show you, right here. That's about where we consolidated, about 36.40 or so. And the next resistance or target up about 44. If we can take out 44, 47.32, and that's all I'd be looking for at this point in time. If the market holds up and this sector gets some traction, maybe some additional targets later. Oh, another thing to note here too is not just price resistance. You can see a confluence of moving averages. Now, this one's in a bear market like a lot of these stocks. A lot of these are bottoming plays, so keep that in mind. Some are continuation plays, they're already in uptrends, but you can see here, I think you can make it out, that's the 200-day moving average in blue. Here's the 200-day in red. And they are coming perfectly together right now, almost perfectly. There's a 200-day exponential right here and the simple right there, and it gapped above both of those. So you had a breakout not only above a fairly well-defined downtrend line and price resistance, but you also took out those moving averages which have contained it. You can see when this stock is in a bull market or a bull trend, here's those two moving averages acting as support on the way up. And then when the trend was broken, right here, they crossed below both the 200 simple and 200 exponential, and then they act as resistance on all these back tests there, and it was rejected. So this is one of the better looking ones in my opinion for that reason, both price and moving average breakouts. And again, how far does it go? Well, that's going to depend on the sector. Sometimes these things can march to their own drumbeat, but as I said, birds of a feather tend to flock together. All right, MOXC. It's got some work to be done. It's a low price stock. It's below $1. It's usually bearish when a stock trading below $1 can recover that level. If they trade there too long below $1, they risk being delisted. So if it can pop and recover $1, it's done it a few times, but it couldn't hold it. They tried to do it right here, and it ran into this downtrend line right here. So this one needs to recover $1 and take out this trend line. Low price, high risk. Vegas money only or speculative traders. Not one of my favorites, but it was worth pointing out. I have flagged it. SFUN, Fang Holdings Limited. Big divergent low right here. See the positive divergence down at the bottom, but there's a trend line it needs to take out. Trend line and your 200-day simple moving average is just above it, and you can see that's also capped the last rally right there. The trend line and the 200 together. So it has work to be done. They just did a 1-to-10 reverse stock split, brought it up to $12 a share, so it would have been $1.20 before that. It's a little financial engineering, but that's what the stocks do. Again, they don't want to risk getting delisted, so they'll do the reverse split to get the stock up. So work to be done. There's your levels to watch. You can set a price alert, probably the best thing to do, either above the trend line or the 200-day simple moving average, or set it above both. But you can see there's a 200-day acting as support there and acting as resistance there when in a downtrend. So those are levels to watch. GAIA, this one looks to be building energy here. It has a pretty well-defined resistance about 972. It has a few pops. You have to recognize what security you're trading. Is it have a history of these whipsaws? And if so, then you just have to take it with a grain of salt. Now, one of them will probably stick eventually if you break out enough. So a break above 972, maybe a half position, and if you see it clearly, take out these previous candles right there where you had the whipsaw. But a lot of reactions on that level, and again, just a few whipsaw signals. Other than that, it's really been testing 972. So a pop above there. Again, depending on what the market does, it's the kind of stock I would just set it and forget it. Set a trailing stop and let it run. If it breaks out, I'll try to revisit these and give you targets. But I could see one up here, potentially all the way up there, about that 1455 level. Undoubtedly some stops along the way, of course. I can see a level there and a level right here. So there's your price levels, so potential targets if it breaks out. SOGO, there's a downtrend line plus 450 resistance level, and like a lot of these, a confluence right there of the 200-day simple and exponential moving average. It's flirting with the 200-day simple right now. It got checked all for about a week or more right here, pulled back, trying to get it there, but price resistance. So there's a confluence of resistance overhead, bullish if it can take it out, and I'm highlighting them as potential bottoming plays because just like back here and right here, the last two times we had positive divergence, divergent low. This one led to a 54% rally, and this one led to a 70% rally. And guess what, guys? They were bear market rallies. This thing hasn't been in a bear market, but I'll take 54% or even a fraction of that, or 70% or any fraction of that all day long. Now, look, we've already moved up off the bottom about 38, 40 something percent. But again, pretty big resistance levels that could pop above 450 could take us up here to 557, and that'd be a pretty decent move if so. And then potential targets here. Again, we'll just see how the sector performs in the coming days to weeks here. TC, low price, $1.52 a share, needs to break 166. Like a lot of these stocks, there's been some whipsaws lately, but you know, tap. The more you tap on a resistance, more likely it is sooner or later to go. So look for a break above 166. Target would be 240 on that one, and I think that'd be enough. You know, a little stock like this, and probably just take the money and run there. It'd be about a 45% return if hit. A few more. WB, Wevo Corp, nice breakout right there. A little downtrend line, a little bullish falling wedge. You know, and this is a wash, rinse, repeat type stock. It plays well to the technicals. Divergent low, rally. Divergent low, rally. Divergent high with a rising wedge, correction. And really, all before all said and done, this correction. And now you have this right here. You have the downtrend line, and the divergence line gives you that bullish falling wedge. You had a breakout and a back test. It back tested for about a couple of weeks here. Back tested, then boom, yesterday, along with the sector, a lot of momentum in the sector, it popped big. You know, from the close, that was about a 18% gain yesterday, a little bit higher at the highs, and now it's right above that 40, right below the 40.57-ish resistance. And you can probably see here, I'll turn up the 200 exponential as well, you can see them both. You have those same thing, you have the moving averages coming into play, and you can see those little buggers have been capping advances in the bear market. So you might say, well, Randy, why don't I just short, you know, rallies into that? You could, but sooner or later, and again, it depends on your views on the market, how comfortable you are. If you think the Fed's going to keep pumping liquidity and has the power to continue to lift this market, the U.S. market, for a while, and or of course China's market, a lot of these are Chinese companies, then you can do that. But I don't like shorting stocks that look poised to break out, so that's not my preference. Probably get a pullback there, but I'm showing you all the times we've been checked here at the 200-day exponential and simple moving average. It's check here at the simple, the blue line, and they're both coming in together there. So bottom line is a pop above 40.57. That, first of all, that's very well defined resistance. That should bring in buyers, and then both these moving averages if they get taken out. And if that happens, then what happens? It starts potentially starts a new trend, because these moving averages have defined this entire or the bulk of the downtrend since we took them out. This stock took them out right here. You can see right there. There was your breakout. I'm trying to show you breakdown below both, back tested both, and then every other time it back tested, you can see it's capped it. And in a bull trend, it did the opposite. It acted as support on the way up. Okay, a few more. KRKR, 36KR Holdings. Divergent low, relatively new company. Looks like it went public here in late 2019. Been moving down, took out this downtrend line here that was led to this rally, but it's now put in a divergent low. Usually like to see a little more price history, but I thought it was worth mentioning here. PPO is starting to turn up. And again, if the sector gets momentum, it'll probably catch a sympathy bid along with everything else. So I don't really see a breakout point or an objective entry, but I can say that it's not far off those previous lows. So the story on this one, again, if you're bullish, looking for long setups. If you're not, just stand aside for now. But it's roughly here at that previous low right there, and so you could take it here at support with a stop somewhat below. That would be objective. SOHU. Little breakout here, same thing. If I didn't, I don't think I covered this one. Same story on a lot of these. You can see the 200-day simple and exponential moving averages are right here, right about. It just took them out, but only by a slight amount yesterday. Here's yesterday's candle. There's the moving averages and a big price resistance at 952 right there. So if the breakout can stick, 1332 and then 1470. There's the sector itself. Remember, I'm highlighting a lot of the bottoming plays. The sector is getting a little long in the tooth, but it's still above trend for now. CANG, breakout, beautiful little downtrend line there. Bullish falling wedge pattern, positive divergence. Wish I would have seen that one earlier. So since the breakout, it rallied about 28%. But if we can get over, same story. A lot of these are at these 200-day moving averages. They could turn the momentum in the sector, and there's potential targets. Low price, relatively low volume stock too, by the way. LOV, downtrend line right here, the little symmetrical triangle pattern. If I can pop that, 634 is a potential target. TrueCar, not a Chinese company, obviously. TrueCar is, if you're buying a car, you can go to this website and they'll tell you what everyone else paid for the car or truck that you're trying to buy around your area, what's a good price if you can get it. But interesting chart, because you have the downtrend line right here, 304 price resistance. You have a confluence of resistance levels. It's in a bear market, make no mistake about it, like so many stocks are right now. This is what I led the video with, really much the tale of two tapes, what the FANG stocks are doing and then what a lot of other companies and sectors are doing. But there it is. We had a divergent low there, 304 downtrend line, and your 200-day moving averages just above that could spark a rally if taken out. Otherwise, resistance is resistance until unless taken out. So this one's in a bear market and may continue to remain in a bear market for months or even years. All right, let's wrap it up here. And this has been Randy Finney with Right Side of the Chart. Hope you enjoyed.